CBS News published a piece today asking whether silver could hit $200 per ounce this March. And when a mainstream outlet like CBS, not a silver channel, not a precious metals newsletter, not a YouTube channel with a stack of coins in the thumbnail, asks that question publicly, something structural has shifted in how the broader market is thinking about this metal. I read the entire CBS piece. I went through every expert they cited, and I am going to do something that piece did not do. I'm going to tell you exactly what they got right, exactly what they missed, and exactly what the data actually says about whether $200 silver this month is possible, probable, or neither. Not opinion. Data. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1. What CBS News actually published and what they said. The CBS News article published today states directly that silver could realistically hit or even surpass $200 per ounce this March, giving current investors reason to celebrate and prospective ones an urgent push to get started before that plays out. J.P. Morgan. That is a mainstream financial outlet making a $200 call, not a fringe silver bug, not a Reddit thread. CBS News. The same publication that covers the Federal Reserve, the jobs market, and the broader economy for a general audience. Here is the factual timeline CBS laid out. After the price of silver smashed through a record $100 per ounce milestone in late January, silver sharply declined from $116.61 per ounce on January 28th to $70.90 on February 5th, barely a week later. That marked an almost 40% decline. Now, at the start of March, it is often listed in the $80 to $89 per ounce range. J.P. Morgan. That timeline is accurate. I have covered every one of those moves in detail on this channel. The $116 peak, the $70 crash driven by the Kevin Warsh Fed nomination shock, the recovery back toward $91 before this week's CME 36% margin hike pushed it back to $82 to $84. Now here's where I start separating what CBS got right from what they missed. Because the article frames the $200 question correctly at the headline level, but does not go deep enough into the mechanics of how that number actually gets hit. And it does not go deep enough into the mechanics of why it might not. Both sides matter. Let's build them. Section 2. What CBS got right. The structural case for $200. CBS cited multiple expert voices in their coverage, and the structural argument they presented is directionally accurate. Let me give you the full version with the actual data behind it. Silver is up more than 157% year over year as of this week, making it not only one of the fastest growing precious metal assets right now, but also one of the fastest growing investments overall. Fortune, that is not a speculative narrative. That is the trailing 12-month return on physical silver. Since 2021, the global silver market has run in deficit for 5 consecutive years. Industry estimates suggest cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. Kitco read that number carefully. 820 million ounces of cumulative deficit. That is not a temporary imbalance. That is 5 years of the world consuming more silver than it produces, every single year. And the deficit is not shrinking. The Silver Institute forecasts a 67 million ounce deficit in 2026, meaning the global market stays undersupplied for a 6th straight year. Light finance. Now add the demand side. Industrial demand is the most significant contributor to the rise in silver price. China's tightening of silver export licenses from January 2026 is squeezing global physical supply further, reinforcing scarcity. Solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications all require silver, and this demand is growing far faster than mine output. Light finance. And then add the supply constraint that most people underestimate. Global mine production peaked around 2016 and has since declined while demand has continued to rise. With roughly 70% of silver produced as a byproduct of base metal mining, higher prices alone cannot quickly bring new supply online. Investing live. Higher silver prices do not automatically produce more silver mines, because most silver comes out of copper and zinc mines as a byproduct. You cannot open a silver mine in response to a silver price spike. You can only open a copper mine, which takes years, and hope the silver byproduct follows. That structural reality is what CBS got right, and it is the foundation of the $200 argument. A market running 67 million ounces short per year, with supply that cannot respond to price, with industrial demand that is largely price insensitive, is a market where extreme price moves are not irrational. They are the mathematical outcome of basic supply and demand arithmetic. Robert Kiyosaki, author of Rich Dad, Poor Dad, called silver the structural metal of the modern economy and said its role in technology makes it more valuable than gold. He argued that in today's technology age, silver is elevated into an economic structural metal, much like iron was the structural metal of the industrial age. Metals Daily. That framing is more than a quote from a popular author. It is a framework that explains why industrial silver demand is price insensitive. Solar manufacturers need silver. EV makers need silver. AI data centers need silver. They do not stop needing it because the price doubled. They absorb the cost or reduce efficiency, but they keep buying. Section 3. The math to $200. What it actually requires. Let me do the arithmetic that the CBS piece did not fully walk through, because $200 is a specific number and specific numbers require specific conditions. Silver is sitting at approximately $84 today after this week's CME margin hike flush and the NFP shock recovery. To get from $84 to $200, you need a 138% move. That sounds enormous. But consider the context. Silver more than doubled over the period from early 2025 to early 2026, rising from approximately $30 to over $100. JP Morgan. That was a 233% move. It happened. It is in the data. So a 138% move from current levels to $200 is within the range of what this market has already demonstrated it can do in a single cycle. The question is not whether silver can move that much. It clearly can. The question is what catalyst combination drives it. Peter Reagan, financial market strategist at Birch Gold Group, told CBS that achieving $200 silver is certainly possible, but under extraordinary conditions and not necessarily based on current trends. Achieving such a price would likely take an extreme decline in currency values or an extreme increase in inflation. One India. That is the honest expert framing. Extraordinary conditions. What does extraordinary look like right now? The Iran war is in day 7. The Strait of Hormuz has near zero tanker traffic with insurance removed. The U.S. economy just lost 92,000 jobs in February while oil is surging. The Federal Reserve is frozen between a deteriorating labor market and rising energy inflation. Kevin Warsh's nomination is stalled in the Senate with one vote blocking it from clearing committee. And the COMEX vault has lost 47% of its registered silver in 4 months. Brett Elliott, director of marketing at American Precious Metals Exchange, noted that for silver to reach $200 from current levels would require something intense to generate another parabolic price move. It would have to be something like a major exchange defaulting on their contractual obligation to deliver silver. One India. That statement is significant. A senior executive at a major precious metals exchange is publicly naming COMEX delivery failure as one of the conditions that gets silver to $200. That is not a fringe scenario being floated by a YouTube channel. That is an industry insider naming the specific mechanical trigger. COMEX now shows clear signs that its contracts face an extremely high probability of delivery failure, with the March 2026 contract being the first likely casualty. Global silver supply has been in persistent deficit for 5 consecutive years, with the 2026 shortfall projected to approach 200 million ounces. Bullion Vault. The path to $200 requires one or more of the following. Hormuz stays closed for 2 months or longer, driving persistent energy inflation that forces emergency Fed action. COMEX faces a partial delivery failure on the March contract that breaks the paper price's credibility and forces physical price discovery to take over. The Warsh nomination fails and Fed policy uncertainty creates a sustained dollar decline. Or all 3 happen simultaneously in the same 30-day window. None of those scenarios are certain. All of them are live. Section 4. What CBS got wrong. The parts of the story they missed. Now I am going to give you the honest counterweight, because the CBS piece has real gaps, and you need to know what they are. The first thing CBS missed is the solar substitution story, and this is a big one. Silver demand from photovoltaic solar installations is expected to fall to roughly 194 million ounces this year, marking a 7% year-on-year decline. This drop comes even as global solar capacity continues to expand by around 15%. Silver now accounts for an estimated 17 to 29% of photovoltaic module cost per watt, up sharply from just 3% in 2023. As prices climbed toward and above $80 per ounce, manufacturers intensified substitution efforts. Chinese producers are leading the transition, with Longi Green Energy Technology announcing plans to replace silver with copper in its back contact cells, with mass production expected in the second quarter of 2026. Light Finance. This is the biggest structural threat to the bull case that CBS did not mention. The single largest industrial consumer of silver is the solar industry at approximately 194 million ounces per year. And the solar industry is actively engineering silver out of its products because silver has become too expensive. If that substitution accelerates, one of the core pillars of the demand story weakens. The second thing CBS missed is the volatility risk on the downside. The article itself notes that even if the price of silver breaks $200 this March or comes close to it, there is no guarantee it will stay there for particularly long. J.P. Morgan. But the piece does not fully explain the mechanism. What happened at 116s in January can happen at $200. A margin hike, a Warsh-style shock, a ceasefire announcement, any of these can produce a 40% correction from any price level in a matter of days. $200 with 40% downside risk is $120. That is not the same as $200 being a stable floor. The third thing CBS missed is the Motley Fool counter-argument. The Motley Fool published a direct rebuttal stating that silver reaching $200 this year is unlikely and that history suggests further downside might be more likely. Their argument centers on the fact that silver surged 144% in 2025, largely on speculative positioning, and that the mean reversion risk after such a move is substantial. The Sunday Guardian. That is a credible institution making the direct opposite argument from CBS on the same question. Both cannot be right, and you deserve to know both exist. The fourth gap is the J.P. Morgan projection. J.P. Morgan projects silver could average $81 per ounce in 2026, more than double its 2025 average. That forecast depends on global demand and economic conditions. Late finance J.P. Morgan's base case average for the entire year is $81. CBS is asking whether silver hits $200 this March. Those two things can both be technically true. Silver could spike to $200 and crash back to $60, producing a full year average of $81. But the CBS framing implies $200 is a sustainable level, which J.P. Morgan's numbers do not support. Section 5. The honest probability framework, what $200 actually needs in the next 30 days. I am going to give you the honest probability assessment because anyone watching this deserves specifics, not vague bullishness or vague bearishness. $200 silver this March requires all of the following to happen simultaneously. First, the Strait of Hormuz remains closed for the rest of March. Insurance stays removed. Tanker traffic stays at near zero. This drives energy inflation that breaks Fed credibility and forces dollar devaluation. Probability, possible but not certain. No ceasefire framework has been announced as of today, but wars end unexpectedly. Second, the March COMEX delivery process, which is live right now, produces visible delivery stress. Either registered silver drops below 60 million ounces, or individual contracts begin settling in cash instead of physical metal, or EFP premiums spike dramatically, indicating that New York is paying to move physical demand offshore. Currently, 10,526 contracts representing 52.63 million ounces are standing for March delivery against 86 million ounces registered in the vault. This represents the highest 2-month delivery rate in exchange history. FX Street. The delivery stress is real. Whether it produces visible failure is the open question. Third, the Federal Reserve either cuts rates unexpectedly before the March 18th meeting or signals multiple 2026 cuts at the March 18th FOMC. The NFP minus 92,000 print makes this more likely than it was 72 hours ago, but the Fed has been paralyzed by conflicting signals for months. One bad jobs report does not guarantee emergency action. Fourth, physical demand from Asia continues accelerating. The most striking signal in today's silver market is coming from China. Physical silver pricing on the Shanghai Gold Exchange has decisively broken away from Western paper benchmarks. Physical silver is being regarded as far more valuable than what Western paper prices currently reflect. Investing live. If Shanghai premiums widen further as COMEX delivery stress builds, the price discovery gap between physical and paper markets reaches a breaking point. All four simultaneously this month. That is the $200 scenario. Each one individually moves silver. All four together in 30 days produce something that looks like a vertical price move. My honest assessment, $200 this March is possible. It is not probable as a base case. The most likely outcome is silver finding a range between $85 and $105 as the market processes the NFP shock, the Iran war trajectory, and the March COMEX delivery data. A move above $120 by month end is plausible if two of the four conditions above hit simultaneously. $200 requires all four. That is a lower probability outcome, but it is not zero. Section 6. The bear case. What sends silver lower from here? The Motley Fool's argument deserves full presentation. Their view is that silver's 144% surge in 2025 was fueled by speculative positioning on top of a real supply story, and that the speculative excess has now been partially or fully cleared by the margin hikes and the war shock. Their conclusion is that further downside is more likely than $200. The Sunday Guardian. The strongest version of the bear case adds two specific risks that the $200 bulls are not pricing correctly. Solar manufacturers are intensifying substitution efforts. LONGi Green Energy is replacing silver with copper in mass production starting second quarter 2026. Jinko Solar is on a similar path. If these transitions succeed at scale, silver loses a 194 million ounce per year demand anchor. Light finance. That is not a small adjustment. That is the largest single industrial consumer of silver beginning to engineer the metal out of its products. And the second bear risk. Even if industrial consumers do not fully replace silver in their operations, price increases may lead them to discover ways to reduce its broader use case. This would inherently result in decreased demand and in turn decreased price action. Finance magnates' demand destruction is a real force at high prices. It is what ended the 1980 silver spike. It is what ended the 2011 silver spike. It can end this one. The bear case does not require a conspiracy. It does not require manipulation. It requires solar manufacturers to succeed at copper substitution and the Iran war to resolve faster than the market expects. Both are live possibilities. Section 7. What to watch. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on a paid service, that is a scam. CME delivery reports. Published daily after 3 p.m. Eastern by CME Group. This is the most important data you can watch right now. Watch how many of those 10,526 March contracts actually stand for delivery versus roll forward or take cash premiums. The link is in the description. COMEX registered silver inventory, updated daily. Watch whether it drops below 80 million ounces through March. A vault running below 80 million against 52 million ounces of standing delivery demand leaves almost no buffer. That is the visible stress scenario. Shanghai Gold Exchange premiums. If Shanghai physical silver moves more than $30 above Western paper prices, Asian physical demand is telling you the paper price is disconnected from physical reality. That gap widening is one of the preconditions for the $200 scenario. Solar substitution announcements. Watch LONGi Green Energy, Jinko Solar, and Ico Solar for production timeline updates on copper-based cell technology. If mass production starts ahead of second quarter 2026, the demand destruction risk moves from theoretical to operational Iran war ceasefire signals. Any Reuters or AP report of back-channel diplomatic communication, Oman or Qatar mediation, or UN framework discussions changes the Hormuz timeline probability and directly affects the $200 scenario's viability. Section 8. The honest conclusion. CBS News asked the right question today. Could silver hit $200 this March? They laid out the structural case accurately. The 40% crash from 116s, the recovery to $80 to $89 range, the ongoing supply deficit, the Iran war context, the rate cut repricing after today's NFP minus 92,000 shock. What they missed is the solar substitution threat that is the single most credible fundamental challenge to the bull case. What they missed is the JP Morgan $81 average forecast that sits in direct tension with the $200 headline. What they missed is the motley fool counter-argument that speculative excess has been cleared, and mean reversion is more likely than a new parabolic leg. Here's my honest framing. 5 consecutive years of supply deficit. 820 million ounce cumulative shortfall. COMEX vault down 47% since October. China export licensing active. Iran war with Hormuz near zero traffic. NFP minus 92,000 confirming rate cuts are back on the table. Kitco against that. Solar substitution accelerating. JP Morgan base case, $81 average. Motley fool calling downside more likely. CME margin hike mechanism already flushed leveraged longs once this week and can do it again. $200 this March is not a prediction I will make with confidence. It is a scenario I will not dismiss with confidence either, because the conditions that would produce it are not fictional. They are the live intersection of a physical delivery crisis, an ongoing war with a closed strait, a jobs market cracking in real time, and a Fed that has no clean exit. What CBS got right is that the question is no longer absurd. What they got wrong is framing a tail risk scenario as a base case without fully presenting the counter evidence. Your job is not to trust CBS. Your job is not to trust me. Your job is to pull the CME delivery report today, check the registered inventory tomorrow, watch the Shanghai premium this week, and monitor the Hormuz situation through this weekend. The data is public. The mechanisms are understandable. The scenario analysis is not that complicated. The only thing required is to actually look at it. Invest with logic, not hype. Protect your capital. $200 silver is a real possibility under specific conditions. Make sure you understand those conditions before you position for them. Drop $200 or bust in the comments if you think silver hits $200 before April 1st. Drop show me the data if you think the bear case deserves more credit than the mainstream coverage is giving it.